Good afternoon. Since the September meeting of the Monetary Policy Committee, global economic conditions have remained weak and global inflation low. Central banks in advanced economies provided more monetary accommodation, helping to ease global financing conditions, but further easing appears less likely. Downside risks from the heightened trade tensions and geopolitical developments remain. Despite a rebound in local GDP in the second quarter of this year, indicators suggest that economic activity will remain weak for the rest of the year. Recent monthly inflation has been lower than the midpoint of the inflation target range, as owners' equivalent rent, food and services inflation remain subdued. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, was 3.7% in October. Goods price inflation was 3.1%, while services price inflation remained at 4.2%. Food and non-alcoholic beverage price inflation slowed to 3.6%. The bank's measure of core inflation, which excludes food, fuel, and electricity, remains unchanged at 4%. Producer price inflation for final manufactured goods decreased to 4.1% in September. The medium-term inflation outlook is largely unchanged since September. The inflation forecast generated by the SARB quarterly projection model is unchanged compared to September, averaging 4.2% in 2019, 5.1% in 2020, and 4.7% in 2021. Headline inflation, CPI inflation is expected to peak at 5.3% in the first quarter of 2020 and settle at 4.5% in the last quarter of 2021. The forecast for core inflation is lower at 4.2% in 2019, at 4.5% in 2020, and remains steady at 4.6% in 2021. Food price inflation continues to surprise to the downside on a monthly basis and is expected to peak at about 6.1% in the third quarter of 2020. Inflation expectations continued to moderate gradually. According to the Bureau for Economic Research, third quarter survey, expectations for headline inflation are down slightly for 2019 to 4.6%. Expectations for 2020 remain unchanged at 5% and eased from 5.2% to 5.1% for 2021, reaching the lowest level since 2007. Five-year ahead inflation expectations also decreased to 5%. The inflation expectations of market analysts in the November 2019 Reuters Econometer survey remain unchanged at 4.3% for 2019, revised lower to 4.7% for 2020, and are unchanged at 4.8% in 2021. Market-based expectations implicit in the break-even inflation rates, that is the yield differential between conventional and inflation-linked bonds, have moderated somewhat since the previous MPC. Five-year break-even rates are currently about 4.5%, and 10-year break-even yield rates are at 5.4%. Global GDP is expected to average 3% in 2019, rising to about 3.4% in 2020. While trade and manufacturing indicators continue to be weak, services have remained more resilient, keeping overall global growth rates up. However, services have shown weakness in some regions, and a range of downside risks to growth remain. These include geopolitical developments, trade tensions, further oil price shocks, and high levels of corporate and sovereign debt. Across most countries, there is limited policy space to respond to shocks. Inflation outcomes and inflation expectations in most advanced economies remain below targeted levels. Barring significant shocks, monetary policy in major advanced economies will remain accommodative over the medium term. While global financial market sentiment has turned more positive in recent weeks, the risk of renewed market volatility remains high. Since the September MPC, the rand has depreciated slightly by 0.6% against the US dollar and by 0.8% against the euro. The implied starting point for the rand is 14 rands 94 against the US dollar, compared with 14 rands 88 at the time of the previous meeting. While the rand has benefited from improvements in global sentiment, investors remain concerned about domestic growth prospects and fiscal risks. Although GDP growth rebounded to 3.1% in the second quarter, longer-term weakness in most sectors remains a serious concern. Based on recent short-term economic indicators for mining and manufacturing sectors, the third quarter GDP outcome is expected to be weak. Public sector investment has declined. Export growth remains low, whereas government and household consumption continue to grow, albeit modestly. Business confidence remains weak. The RMB BER Business Confidence Index fell to 21 points, while the ABSA Purchasing Managers Index rose to 48.1 points in October. The SARB's Composite Leading Business Cycle Indicator also continued to trend lower. The forecast of GDP growth for 2019 is revised lower at 0.5%. The forecast for 2020 and 2021 have decreased to 1.4% and 1.7% respectively, due to lower growth than previously expected in the third and fourth quarters and downward revisions to global growth. The MPC assesses the risks to the growth forecast to be to the downside. Escalation in global trade tensions, geopolitical risks, further domestic supply constraints, and or sustained higher oil prices could generate headwinds to growth. Public sector financing needs have risen, thus raising the prospect of further pressure on the currency and pushing borrowing costs for the broader economy higher. Implementation of prudent macroeconomic policies and structural reforms that lower costs and increase investment, potential growth and job creation remains urgent. The overall risks to the inflation outlook are assessed to be balanced, but uncertainty about inflation risks is unusually high. Demand-side pressures remain subdued, and house rental prices are expected to increase at only moderate rates. Global inflation should also remain low. Food price inflation has continued to surprise to the downside, but rising imported food prices and uncertain domestic weather patterns raise uncertainty about the future price trajectory. Further upside risks to the inflation outlook include wage growth and fuel, electricity, and water prices. The risk of further capital flow volatility has also increased, which could put pressure on the exchange rate. The MPC welcomes the sustained moderation in inflation outcomes and inflation expectations, and would like to see inflation expectations anchored closer to the midpoint of the inflation target range on a sustained basis. Against this backdrop, the MPC decided to keep the repurchase rate unchanged at 6.5% per annum. 3 members preferred to keep interest rates on hold, and 2 members preferred a cut of 25 basis points. Monetary policy actions will continue to focus on anchoring inflation expectations near the midpoint of the inflation target range in the interests of balanced and sustainable growth. In this persistently uncertain environment, future policy decisions will continue to be highly data dependent, sensitive to the balance of risks to the outlook, and will seek to look through temporary price shocks. The implied path of policy rates over the forecast period, generated by the quarterly projection model, indicated 1 repo cut of 25 basis points in the 3rd quarter of 2020. This remains a broad policy guide which could change in either direction from meeting to meeting in response to new developments and changing data and risks. That concludes our statement, and we at this stage would like to take any questions that you might have, and the panel here would deal with your questions. You will also find attached at the back of the statement the dates for the MPC meetings for 2020. Who are the early takers? Yes, sir.
Good day, Governor and the panel. I'm Mfonako from Reuters News. I wanted to ask, was the upcoming February budget a consideration in terms of timing of the decision? Second question is, how much of a consideration was the fact that other emerging market banks have been cutting rates and perhaps cutting them aggressively, and that obviously has an impact on the attractiveness of the yield offered by South African assets? How much of that was a consideration in your discussions? Thanks.
Any other? Yes, ma'am.
Governor, it's Pranesha from Bloomberg. Also just want to get some insight into your discussions. The MTBPS showed a rapid deterioration in the fiscal outlook, and we're also a step closer to a full house of junk ratings, with Moody's having changed the outlook. How did that factor into your discussions?
Yes, sir.
Good day, Governor. Lucanio from Business Day. Governor, seeing that the inflation outlook this year was so much lower than what we were predicting this time last year, how concerned are you that policy today might be based on forecasts that might turn out to be wildly maybe pessimistic, maybe like we might have more room than you maybe you think?
Yes, ma'am.
Governor Hilary Joffe from Business Times. You continue to emphasize that you are guided by trying to get inflation expectations down to the midpoint of 4.5%. So 2 questions. The first is, are you convinced that expectations are a major factor in shaping inflation, the inflation outlook? Is there a sort of a direct correlation? And the second is, have you considered asking the Treasury or the Finance Minister to change the range to a point target of 4.5% to clarify what some would say already is the target?
Thank you very much. But still, Mfuneko, your question is also related to what Prunesha had raised in terms of the budget and in terms of the MTBPS. We don't know what is in the February budget, so there was no way in which we could factor it into the decision today or factor it into future decisions. We do not know what is in that budget. But Prunesha asked the impact of the MTBPS, and very clearly the fact that the rating agencies had reacted in the manner that they had reacted suggests that they have concerns about the MTBPS. If the rating agencies have a concern, those will then begin to factor into the country risk premium. And the manner in which we end up having to decide what the neutral rate is for South Africa is that we take what the foreign neutral is and we adjust it for South Africa's specific country risk. And clearly, if the South African country risk rises, then what you have is that neutral rate is then deemed to be higher. And if it is deemed to be higher, that suggests that where you are sitting in terms of the ruling stance, it could suggest that you are more accommodative without becoming accommodative yourself. It's purely a shift in the country risk premium. Put simply, if this country is to bring down the long-term cost of capital, we have got to bring down the country risk premium. And we have got a history with that. We know when we were in a good space and country risk premium was low, the cost of capital in this country was always lower. Was Moody's a consideration, as we had said? It's what all the agencies had to say and what that could fit into the country risk premium that will fit itself into the neutral rate. Was it a factor that other emerging market banks are cutting, and thus it changes the relative rates between us and those countries? We always look at what is happening in South Africa's major trading partners. But what feeds into our neutral real rate in the main would be the neutral rates of the G3 economies, being the US, the Euro area, and Japan, for example. But even when those central banks move their policy rates, we do not try and match them basis point for basis point. What we do is to analyze developments in the South African economy and what the changes in policies in those other countries mean for capital flows in South Africa, and by extension what it could mean for the exchange rate. And we then have to take a view as to whether that is a once-off move, and if it is a once-off move, we see through it. And if it is not a once-off move, and it ends up fitting itself into domestic price formation process, then policy has got to react to that. And it could be that the shock is good for inflation, meaning it brings inflation lower, or it could be that it is adverse for inflation, meaning it raises inflation. That is how the transmission from developments elsewhere in the world get taken into account in our deliberations. And of course, we look at inflation, because that's what says it. But it also has an impact on competitiveness, and that by extension also have an impact on growth. And we have got to take account of those. Why do we have to take account of growth? We've got to take account of growth because our responsibility, our mandate is in the interest of balanced and sustainable growth. That's one. And secondly, is that the output gap is a very important input into the domestic price formulation. And for us to know what the output gap is, we have got to know potential, and we have got to know what we expect growth to be in the future, because you do not determine policy on the basis of today's indicators, but on what indicators are likely to evolve into in the future. Simply put, what would be the outlook for both growth and for inflation? Lucanio, inflation surprised on the downside this year. In the monetary policy review earlier in the year, we did a study and a comparison of what our forecast was at a particular point in time and what the ultimate outcome was. We compared ourselves to all the other forecasters in the economy. The bad news is that we were all wrong on the forecast relative to the outcomes. The good news are we were less wrong than the others. We took it further and we said, what happens with other central banks? And we compared our forecast relative to the outcomes and say, what is the deviation? And what has been the experience of other countries? And we were within range. So, let's get things clear. The reason we keep on emphasizing data dependency is because as data evolves, it changes your outlook, and by extension also changes what you are going to do. And if you make the wrong call, you might find yourself that with hindsight, you say, oh, I could have done something else. But as we know in life, hindsight is perfect. You can never get things wrong with hindsight. So when there had been a deviation, we then try and go back and say, what caused the deviation? And by a big measure, it had been food prices, which kept on surprising on the downside. There had been other factors like owner equivalent rent and so forth, but by a big measure, it had to do with food prices. Hillary, inflation expectations and whether we are convinced as to whether they are shaping the inflation outcome. There is no doubt that they do. The academic literature and the evidence is compelling that there is a very strong relationship between expectations and inflation outcomes. There is a caveat, and the caveat is you have got to take a view about whether the inflation expectation formation is rational and forward-looking or whether it is adaptive. If inflation expectation formation process is forward-looking and rational, what it would mean is that the price setters in the economy look at what future inflation is going to be. And based on what they think future inflation is going to be, they set their prices accordingly, whether they are labor market participants or product market participants. And in that process, monetary policy also becomes fairly easy because it's just so straightforward. All agents look at it this way, and put simply, we then talk of the anchoring of expectations going forward. But that anchoring could be an anchoring around what the central bank wants, or it could be higher than what the central bank wants. It could even be lower. That is not a big problem from a policy perspective. You can deal with that. The problem from a policy perspective becomes when they are de-anchored and they are all over, because then that makes the policy decision process complex. The expectations formation process could also be adaptive, which means that economic agents set their prices based on what the most recent inflation rate is. And if that is the case, if inflation is going up and the price setters are adaptive or backward looking, then you are going to see a spiral in prices, because as the price outcome is published and they see that it is higher, they then adapt to that and they go even higher. If it is that it is adaptive and inflation is going lower, that could be beneficial, because that would mean that they look at the most recent inflation outcome, and the lower it comes, the more they set their prices lower. In South Africa, the jury is still out as to whether it is forward-looking or backward-looking. And in the quarterly projection model, what we do is that we give an equal weighting to backward-looking expectations and forward-looking expectations. And we blend that, and on the basis of that, we generate expectations in terms of the quarterly projection model. Would we consider approaching the National Treasury to change the target from a range to a point? And I like the fact that you said approach, because it's got to be an iterative process between the two institutions. Since the target range was set, many countries around the world have revised their inflation targets. None of them revised it higher. They all revised their targets lower. It is also true that our range is wider than that of other inflation targeters, and might even be on the higher end of our peer countries. Most countries use a point, but there isn't evidence that suggests that a point is better than a range. And in any case, many countries that have a point that will say it's 4.5%. That is our point, plus minus 1.5%. So if South Africa was to have a point of 4.5 plus minus 1.5%, it will be 3 to 6. It amounts to the same thing, but the point does get people focused, because they say that is where they want it to be. We haven't thought of having to approach the Treasury to change to a point as opposed to a range. What the range has done for us is that it has given us the flexibility within the range. We were able to aim for the 4.5 within the target range of 3 to 6. And we are actually pleased that increasingly the analysts and the price setters are starting to talk about that midpoint of 4.5%. And if it is sustained, it will be a welcome development that could actually give a respite to the price formation process in this country. Any others? Amahela.
Good afternoon, Governor. I'm Khalang Bata from Bloomberg News. Governor, we've just seen the SAA workers going on strike, demanding in an 8% wage increase. We were told that SAA management then came back onto the negotiating table, possibly offering 6.5%, which was later withdrawn. The question I have is the MPC at all concerned about the wage negotiations that are well above inflation, impacting the inflation outlook, particularly when we see those coming out of state-owned entities?
Yes, sir.
Hi, I'm Foneko from Reuters again. How concerned are you about the lack of demand in the economy, and do you not see a role for the central bank to use rates to perhaps deliver a stimulus to demand and consumer spending, even if it is temporary? And a second question is, did the MPC consider the sensitivity of government's debt portfolio to interest rates? Is that something that was discussed in the meeting?
Is that it, Lucanio?
Governor, sorry, if I may just follow up on Hillary's question. Do you think it might be time for the government, for the central bank maybe to change its messaging around the midpoint? Because people out there, they seem to think of it as a target. Is it time for clarity that that's actually not the target? It's actually a range or whatever, or is there where you want it anchored? Because I think that the market perception is that that's where the target is. So when inflation goes to 4%, then people say, why aren't you cutting rates? And secondly, if I can have another question, just on the makeup of the MPC, are there any changes afoot to get it back to where it was before in terms of numbers, back to 7?
Is that it from here before I go to the telephone? Sianda?
I have 5 questions, Governor. One from Guy Frost at Spectra. Governor, where do you see South Africa's neutral rate? The sub-bulletin has 2.5. Has that changed given the Fed has now moved down to nearer 0.5, increasing the spread? Raiza Khan, Standard Chartered. Given the weak inflation and weak growth, what will it take for the sub to cut? Felipe Capitalo. Hello, Governor. Would you please elaborate on why your assumption of the neutral rate was unchanged in spite of the recent fiscal news medium-term budget? How do you see the balance of risks from the neutral rate? Peter Montalto, Intellidex. How much of a job is it for the policy rate to encapsulate country real rate risk premiere, or how much is the job of the long end of the curve? Danelli Messiah, Dutch Bank. Please explain the revision in the MPC's exchange rate gap forecast, which seems to have gone from mildly undervalued to mildly overvalued. Is this a correct assessment?
Thank you very much. Chris Lovald, exchange rate gap and country risk. No. Exchange rate gap, country risk, and everything that has to do with neutral. And what would it take to cut? I think I've answered this question before, but I will repeat the answer.
Okay, thanks. The neutral rate hasn't changed from one meeting to the next. The Fed has also changed some time ago, so around the previous meeting, but has indicated that they're no longer looking to further cut rates. Our neutral actually has moved slightly. The risk premium has moved slightly, but the exchange rate component has moved slightly. And on balance, the neutral real rate hasn't moved at all. Our assessment of the rand is not that it's overvalued. Our assessment actually is that it's slightly undervalued. It's depreciated marginally this year, but on balance has been quite stable. I'm not sure how to answer Peter's question. I suppose the point that we would just make is that the risk premium clearly and directly feeds into the long end of the yield curve. And we worry about that because all else equal, that will tend to raise borrowing costs for the economy as a whole, which we would rather not see. Our overall repo setting, of course, is, we think, all else equal, contributing to the inflation rate moving down, but the neutral rate from time to time, when it rises, can push that long rate up. Thanks.
Rashad, can you pick up any question? The one you like.
Yeah, there's an interesting question around how we think about wages and wage negotiations. In some respects, it's kind of not the job of the MPC to make a judgment about whether you're talking of SAA or any other firm about how profits are distributed and how salaries are set. I think that the important thing from the MPC is just to take a sober look at how wage increases relative to productivity has an impact on the inflation outlook, and if wage increases are high relative to productivity, those contribute to cost push pressures. And in the process, if there are underlying sustained cost push pressures as a result of wages, it becomes much harder to think of monetary stimulus, and the reverse applies. I think that one of our real challenges is that there are many cases where I think when we refer to stickiness in the South African economy, is that when you have inflation moderated in the way it does, people still think 6% inflation, when in fact your real wage gains has to be more consistent with what actual inflation is. And I think that's where we have a real challenge in kind of wage formation and wage expectation formation in the economy. Thank you.
Okay, and I thought whilst you were at that one, you could have dealt with the demand.
Yeah, I mean, I guess it's a natural thing. So it is obviously the case that that when we look at, we have recognized in every MPC statement that there are no demand pressures to inflation, that demand is low, and certainly when we look at the case for whether we could stimulate or not, we look at demand in the context of what we think the other risks to the economy are. When we look at economic growth and we look at the reduction of potential, we have to make a judgment of, how much of that is a result of demand contracting, or how much of that is because growth has come down, not because of demand, because of other factors like uncertainty and low business confidence. So I think that, at the end of the day, as you realize from the MPC outcome, there was very robust debate about how you trade off the recognition that there's demand slack in the economy versus what we consider some of the risks to the inflation outlook. And that's ultimately, it's not just a question of saying, is it about demand? It's ultimately looking at demand against what we think the long-term outlook for inflation is. Thank you.
Thank you very much. Deputy Governor Chazivana, what would it take to cut?
What would it take to cut? Okay, so let me start quickly by just adding to what Rashad has said. I think when we look at demand, we also try to understand what is keeping demand down. I think that's quite an important element. When one looks at some of the surveys and what they tell us about consumer confidence, one starts to see that consumer confidence has come down substantially, and that is largely also driven by broader employment prospects in the economy. If one looks at business investment, which is also an important element of demand, that's also driven by low confidence elements in the economy. All of those elements are broadly structural, and these are issues that monetary policy is more or less unable to deal with directly. What would it take to cut? So one of the things that we look at as the MPC is whether we see a sustained decline in inflation over time. And that's something that we have emphasized quite a lot. And what we have seen in recent months is more downside surprises. So you cannot do policy projections or planning around surprises. You plan based on the information that you know. So broadly, what we would say is that if the data starts to indicate to us that there would likely be a sustained decline in inflation, and together with a further decrease in the risk elements that we're highlighting. So at the moment, when we sat down in this MPC meeting, we saw some upside risks to inflation together with some downside risks to inflation, which sort of cancel each other out. So the conditions at the moment are not showing us that inflation is likely to continue declining beyond what the QPM has highlighted as a potential cut in the next year.
Naidu, how do we talk about the midpoint?
Thanks. Chair, we still have a 3 to 6% range set by the National Treasury in consultation with the Reserve Bank. The inflation target is consensually set between government and the Reserve Bank. It is not set unilaterally from one side. So the 3 to 6% target range has not changed. In the last 3 years, we have expressed a clear preference for the midpoint of that target range, being 4.5. There are several reasons why we've done that. The main reason, in some ways, is that we feel that if we are at 4.5, we have more room to respond to shocks in a counter-cyclical manner than in a traditional manner. Put differently, if you're skating along at 5.9 and you've got a drought, you're almost forced to hike interest rates because there'll be some second-round effects that's going to push you over. That's not necessarily good monetary policy. Whereas if you're at 4.5, you've got room to respond to those kinds of shocks, a food price shock or an electricity price shock, or even a certain magnitude of an exchange rate shock. You don't have to act pro-cyclically. You can actually afford to look through certain types of shocks because inflation is pretty well anchored at the midpoint. So we have expressed a preference for a midpoint. We think we've broadly achieved it, but we certainly, there are questions about whether it's sustainable in the medium to long term. We hope that it is, but there are some people who argue that the inflation rate has come down largely because of temporary or transitory factors. I guess our job is to try and anchor that at the midpoint. But we still formally have a range of 3 to 6. We think a range of 3 to 6 implies a midpoint of 4.5, and that's why the preference. So there's been no formal change in that.
Thank you. Funako, you said a sensitivity of government's debt portfolio to interest rate changes. Yes. Yeah. You see, classically, once monetary policy starts to be set on the basis of what would happen to the debt portfolio, you are into what is called fiscal dominance, which means that monetary policy is no longer focused on what it is supposed to focus on, but on what could go wrong with the fiscus if monetary policy does or doesn't do certain things. But classically, this is what the situation is. Government is the premier borrower in the economy. And the domestic lenders would prefer to lend to government first before they lend to everybody else. We tend to call this risk-free rate of return. But what is in the government bond yield are three important elements. One is, what is today's inflation? Why is today's inflation important? It's important because inflation erodes savings. So if I am a saver and I have to lend to anybody else, I would have to take account of what today's inflation is. The second component is that today's inflation is not what inflation is going to be in the future. And I am lending you money for 10 years or 20 years if you have got a mortgage. Then I have got to take a view of what is the likelihood of a deviation of future inflation from today's inflation. And we call that the inflation premium. And the third component is, would this borrower that I am lending money to, would they be able to repay me? In which case, I have to price for the credit risk. But for a country, what we will then end up pricing for a government, you price for the country risk. And the three components then make what goes into the government's bond yield. And so, if the central bank keeps inflation low, it makes government borrowing cheaper. And the more the central bank gets inflation anchored within its target, or closer to its target, the more the price setters say that there are unlikely to be deviations from that inflation, in which case they will lower their inflation premium. That is where monetary policy plays. Country risk premium, that's where government plays. And that has to do with a whole range of things, whether they are fiscal or trade or social policies or structural reform, all of those things, whether they undermine growth or whether they support growth, all of those things will go into the country risk premium. In other words, even the lenders who are outside of the country will look at this and say, what do I need to be compensated for? They would want to be compensated for the uncertainty with respect to your growth outcomes and your macroeconomic stance and all of those going forward. So the way in which we think of it, the impact on government's debt portfolio and the servicing thereof is on the first two components. And the day monetary policy decides to set its policies to try and compensate for government's failures because you are trying to keep the debt portfolio cheaper, you are into the realm of what economists call fiscal dominance. And I do not think that's where we want to be. Lucanio, makeup. We are in a process. We think that we are close to filling the vacancies. They might be at different times, but in the first half of next year, we should be able to fill at least one of those positions. It's a process because this is a fairly intense policy process, and we do become picky about who gets into the committee. But that should happen in the first half of the year. Well, this being the last MPC meeting of the year, let me wish you happy holidays. I hope that you will get a rest. And then we will see you in January. But we do have an appointment with your editors next week. So thank you very much for your attendance.